Equipment financing. Equipment financing is a type of business loan that provides capital specifically for the purpose of purchasing business-related equipment. This can include machinery, technology, vehicles, or any other type of equipment a business might need. The equipment itself typically serves as collateral for the loan, meaning if the loan is not repaid, the lender can seize the equipment. Use cases. Equipment financing is typically used when a business needs to purchase or replace expensive equipment but does not have the necessary funds on hand. This type of loan allows businesses to get the equipment they need immediately while spreading the cost out over time. Best suited for. Equipment financing is best suited for businesses that rely heavily on expensive equipment to operate, such as manufacturing or construction companies. It's also useful for small businesses that may not have the cash reserves to purchase necessary equipment outright. Typical loan amounts. The amount offered for equipment financing can vary widely depending on the cost of the equipment, but it typically covers up to 100% of the equipment's value. Pros and cons of choosing this loan option. Pros of choosing this loan option. Access to necessary equipment. This type of financing allows businesses to obtain the equipment they need to operate or grow. Predictable payments. Equipment financing typically involves fixed interest rates and set repayment schedules, making budgeting easier. The equipment serves as collateral. This means businesses may not need to provide additional collateral to secure the loan. Cons of choosing this loan option. Equipment depreciation. The value of the equipment may depreciate over time, potentially leaving the business owing more than the equipment is worth. Potential for obsolescence. Depending on the type of equipment, it may become outdated before the loan is fully repaid. May not cover additional costs. Equipment financing typically covers the cost of the equipment itself, but may not cover additional costs such as installation, maintenance, or insurance. Qualification criteria. Qualification for equipment financing typically involves a review of the business's financial records and credit score. The minimum credit score required can vary by lender, but typically, a score of 600 or above is needed. The lender will also consider the value and condition of the equipment being financed. Typical repayment terms. Repayment terms for equipment financing can vary, but they are typically aligned with the expected lifespan of the equipment. The interest rate can be fixed or variable. Real-world example. Let's consider a hypothetical business owner named Mark. Mark owns a small construction company and has the opportunity to take on a large project. However, he needs additional heavy machinery to complete the job. Mark applies for equipment financing and uses the funds to purchase the necessary machinery. He repays the loan over a 5-year term with manageable monthly payments. This allows him to take on the lucrative project and grow his business. In the next lesson, we'll learn all about invoice factoring and invoice financing, as well as the difference between them. If you like this video, be sure to check out the rest of our course on building business credit at mybusinesscredit.com.